When I look at the real data, the stuff that's hard for the club and the government to manipulate, that just absolutely proves we were all on the right track with our thinking. The big crash is coming. There's no question. And again, today's December 1st. As I'm doing this, you'll get this video tomorrow. Man, is Lindsey Williams going to be right? The elite, his friend? Be a big crash in the markets before 2016. So the end of 2015 is when he said it could happen. Not could, would happen September to December. Man, we ain't got but 30 days left. Is it going to happen? Is the club backing out? What are they doing? What's going on? I can tell you one thing that's not backing out. All of the data, all of the fundamentals. It's still terrible. Bankruptcies are coming. There's no question. Look at those two commodities giants, Trafigura, Glencore, banks, HSBC firing 50,000 people, all that. The writing's on the wall, plain and simple. And when you look at all this, a Willy Wonka song comes to mind. If you want to view paradise, simply look around and view it. There's nothing to it except, ouch, world's largest pension fund suffers $64 billion loss. Now let's go to the other song in Willy Wonka. Cheer up, Charlie! Oh my God. The thing about being, and this is from Zero Hedge, courtesy of Zero Hedge, one of my favorite sites to visit. The thing about being a pension fund in a world where returns on risk-free assets are at best an inflation-adjusted zero, and at worst, a guarantee loss when held to maturity, is that you're effectively forced to go out and take bigger risks if you want to hit your targets. In the U.S., sector pension funds cling to the fantasy that they can return 7 to 8% while still keeping risks manageable, while a lower discount rate attributable to zero interest rates and near zero interest rates have caused the present value of Eurozone defined benefit plan liabilities to the value of Eurozone defined benefit plan liabilities to soar. In short, the lower for longer rates regime can be tough for large pension funds to navigate as the whole enterprise becomes an impossible balancing act between achieving an acceptable rate of return and managing risk. Earlier this month, Zero Hedge had a little link here. Took a look at the Q3 numbers, quarter three, not to be accused with QE3, just quarter three, for the Government Pension Fund of Norway, which is the SWF. And the picture was not pretty. In what amounted to the worst quarter in 4 years, the fund lost 16% on EM equity bets, which would be emerging markets. All told, that fund lost 5% in quarter three. Enter GPIF. Back in March, Zero Hedge noted that Japan's $1.1 trillion government pension investment fund, the largest pension fund in the world, was a big seller of JGBs in Q4, fourth quarter, as the fund moved aggressively into stocks on the heels of an October 2014 directive from the Prime Minister Shinzo Abe, who encouraged more risk-taking. As a result, QPIF cut its targeted holdings of government bonds and doubled its target for stocks. Here's what Zero Hedge said earlier this year. Pension funds the world over are increasingly adopting the same behavior as other investors in a world characterized by artificially suppressed yields. They're shifting to riskier assets. In the case of U.S. public sector pension funds, this is a necessity because assumptions about investment rates dictate the discount rate used to calculate the present value of liabilities, and so as soon as you admit you can't make 8% when risk-free assets are yielding less than 2% in the U.S. and close to or less than 0% in other locales, if you will, you effectively become even more underfunded than you already were. The solution is to take more risks in order to justify return expectations, and in the U.S., the percentage of funds capital dedicated to equities has risen from under 30% in the mid-80s to as high as 60% more recently, while the fixed income allocation has steadily fallen. As you might, that was the They also said, as you might expect, Japanese public pension plans are also feeling the heat as the Bank of Japan has driven yields on JGBs into the ground by planning to monetize the entirety of gross issuance. The result has been a truly epic shift out of domestic government bonds. As Bloomberg reports, Japan's government pension investment fund sold nearly 50 billion in JGBs in Q4, opting instead to chase after higher returns in the stock market. And I got a feeling somebody's about to get burned. And that somebody, as usual, is the public pension fund itself. Now, clearly, promoting risk taking with assets earmarked for public sector employees' retirement is a strategy that has the potential to go south in a hurry if the market moves against you and because you can't designate your equity portfolio as held to maturity, you run the risk of incurring substantial losses. Matter of fact, I'm going to add a little to that. If you do anything and put your money into anything that runs through this thing called the club and their stock markets and their financial system and their banking system, you're going to incur sooner or later substantial losses. Well, maybe Abe just assumed that perpetual Kuroda plunge protection would ensure that no matter what, equities wouldn't swoon. Or perhaps everyone in Japan still believed that an Abenomics-led, or was that Abenomics-led economic renaissance was just around the corner, and so stocks were the place to be. But whatever the case, Japanese public pension funds' dramatic shift into equities looks to have cost them dearly in quarter three, as GPIF just turned in its worst quarter since 2008. Wow, quick look, surprise there. The 135.1 trillion yen, or 1.1 trillion US dollars worth, government pension investment fund lost 5.6% last quarter as the value of its holdings declined by 7.9 trillion yen. Bloomberg reports, adding that the fund lost 8 trillion yen on its domestic and foreign equities and 241 billion yen on overseas debt. In fact, if you strip out a portfolio of government bonds tied to fiscal stimulus spending, the drop was the fund's third worst on record, exceeded only by declines in the depths of the 2008 crisis and the aftermath of September 11, 2001 terror attacks. So we have two events that we saw market crashes. And we have another one right now happening, according to this data. Same stuff's happening, but the market crash hasn't quite happened yet. So if by chance it still doesn't happen, the crash, by the end of this year, it's going to be another situation where everyone on September 23rd, nothing happened, all's good, not everything's good. Only to find out another month and a half later, November kicks around and the club has started the party. So are you going to write off Lindsey Williams, December 31st, nothing's happened yet? Let me go invest back in the stock market. Are you going to go do that? Did you just hear what I just read you? That ain't got nothing to do with Lindsey Williams. It's got a lot to do with what the hell's happening in the world. Not even the elite friend of his, whatever, giving some kind of inside information. No. This is just called the fundamentals of the whole market looking like crap. And showing so every so often, very recently. Especially very recently. So once again, if people are stuck in a 401k, what are you going to do? What can you do? Oh, I'll get out early. Can't get out early. Why not? Well, because if you have a job, you don't qualify to get out early. You might say, well, then I'll just call my broker or whoever we deal with that company at my job and contact that person to tell them, just take my investment and don't invest anywhere. Just take my money out and just park it on the side in cash. That way, if the market tumbles, you're not affected at all. Your money's sitting there pretty. Whatever it's at right now, it just stays there. Of course, you can add to it like you do every month or every week or whatever out of your paycheck, and it'll still go up, but you're not going to earn any interest on it, but you also won't lose anything. However, you're going to probably find out, some of you, maybe more of you than not, if you make that call, park it in the side and cash since I can't do anything else, I can't take it out, you may find that they tell you, ooh, sorry, you don't have that plan with us. Your company doesn't have the higher level plan, so we can't do that for you. So as crazy as this might sound, you know those little my IRA that Obama created that is invested in government debt, only government bonds? I wonder if it would be a wise idea before the market crash happens to put your money into those government IRAs. After all, you wonder why they created them in the first place, don't you? Just coincidentally, perfectly timed. They were just released a few weeks ago. You can now get into them. And if we have a little market crash, and then they hold it, not all the way, just hold it. Oh man, I don't like what I'm seeing. What can I get into? Call my broker. Oh, safe investment. These things called Myra, Obama's Myra accounts. Okay, do it to save my money. So I don't like what I just saw. Go ahead and put it in there. And then guess who is now financing our country's borrowing? You. Take care.